Welcome to episode 36 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Facebook group and our free Tax Smart newsletter. Links to both of those are in the description of this video. Now, today's topic is all about real estate dealer versus investor. And we talked about this on episode 25 of the Tax Smart Daily a few weeks ago, but I want to dive a little bit more into it because we've been having conversations in our Tax Smart Facebook group about real estate investor versus real estate dealer. Now, the difference between investor versus dealer is big and can be very costly. A real estate investor enjoys capital gain treatment on the sale of their assets, on the sale of their rental real estate. But a real estate dealer has to pay ordinary income tax rates and FICA tax rates, self-employment tax rates on the sale of their inventory, not real estate capital assets. So how does that boil down? Well, let's say we've got a $100,000 gain on the sale of a real estate holding. That $100,000 gain, if I'm a real estate investor, costs me $20,000 in taxes. If I'm a real estate dealer, $37,000 in ordinary income tax plus $15,300 in self-employment taxes. So very expensive to be a real estate dealer, almost 2x, 3x the amount of the tax if you're a real estate dealer compared to real estate investor. Now, how do we determine if you're a real estate dealer or investor? Well, it's determined on a property by property basis, even though we take into account the overall facts and circumstances of what you have going on. To determine whether a real estate dealer can claim capital gain treatment for the sale of real estate, it has to be determined whether at the time of sale, the property was held primarily for sale to customers. Now, primarily means first importance or principally. Ordinary income will result if the following three requirements are met. So that means if you meet the following three requirements, you are a real estate dealer, not investor, and the property will be subject to ordinary gain or ordinary income tax plus FICA tax, that 15.3% tax. So these are the following three factors. The taxpayer is engaged in a trade or business. That's number one. Number two, the taxpayer is holding the property primarily for sale in that trade or business. That's number two. And number three, the sale of the property is ordinary for that business. Now, in episode 25 of the Tax Smart Daily, we talked about number two, the taxpayer is holding the property primarily for sale in that business. There are 9 factors that determine whether or not the property was primarily held out for sale. But what I want to talk about is one of the factors, factor number 4, the frequency, number, and continuity of the sales. Because I think that that's where a lot of people get tripped up. That's the one factor. There's 2 factors actually that the courts weigh more heavily than any other factor. It's factor number 4 and factor number 5. I just said factor number 4 was the frequency, number, and continuity of sales. Factor number 5 is the extent and substantiality of the disposition of the property. So we want to talk about factor number 4 because it's very heavily weighted by the tax courts. What does frequent, continuous, and substantial mean? Well, it's difficult to determine because our prior case law is kind of all over the place. We have had tax court rulings in the past rule that one sale a year will meet that definition of frequent, continuous, and substantial. However, in the context of that case, there were multiple sales, an average of 7 over multiple years. So in one year, they sold 1. In another year, they might have sold 8. And the issue was that one that they sold in 1 year was that frequent, continuous, and substantial, and the tax court said yes. So what this really means is that even if you only sell one property a year, if you're doing it year in, year out, you're probably going to meet that factor of frequent, continuous, and substantial. And that's going to reflect poorly on you under any sort of IRS audit if you claim that that was a capital gain treatment rather than ordinary income and FICA taxes. Now, it is possible that you are maybe you're earning a lot of income as a W-2 earner or a business owner, or maybe you're a physician or an attorney or whatever. You're earning lots of income and you just randomly do a flip. Well, there is some potential that that one flip, if that's all you do, that one flip could be viewed as like short-term capital gain treatment versus being subject to ordinary income taxes plus FICA taxes, because the argument would be that you're not really in the trade or business of flipping. You just had one opportunity that you tackled and you went with. But if you do that a second time or a third time, even if it's over a number of years, that could put at risk all prior transactions too in the overall scope of your facts and circumstances. If everything's taken into account and they see the frequency, the number, and the continuity of sales is there, then they're going to challenge you on that dealer status every single day of the week. So if you're just doing one-off, you might be okay. But if you've got multiple, even if it's one a year for multiple years, you are going to be at risk of being tagged as a dealer, and those properties are going to be at risk of having to pay ordinary tax and that 15.3% FICA tax on the gain coming from the sale of those properties. Now, tomorrow we're releasing an article on investor versus dealer status. It's got all the citations. It's very well built out. And that is on taxsmartinvestors.com. So go ahead and check that out. Sign up for a 14-day trial. You get access to that and the newsletter that we're going to release tomorrow morning. Thanks so much for watching another episode of the Tax Smart Daily. If you have any questions or if anything that I say resonated with you, drop me a line below. I love engaging with our community. It's my oxygen. It keeps bringing me back to the table for more of these videos. Thanks so much for watching, and we'll see you tomorrow.